Welcome to Electrified. My name is Dylan Loomis, and in today's episode, we'll go through a few quick news items, but the heart of this episode will be a Tesla price target that I believe to be very sharp, and I want to walk through some of the financial assumptions that are being made, and we'll explain them a bit more in depth. As always, thank you to all of our patrons, but I'd like to give a special shout out to Jamie Scott, our very newest supporter. We just got some news from the National Grid ESO. If you're not familiar, they are the electricity system operator for Great Britain. Their control room moves electricity around the country second by second to ensure that the right amount of electricity is where it's needed when it's needed. Basically, always keeping supply and demand in the perfect balance. They recently implemented a new IT web-based interface that essentially widens the BM or balancing mechanism access for smaller generators, and that smaller generator in this news article is Tesla. Their new API or application programming interface went live on Wednesday, which will open up the market for non-traditional participants to join through a more simple, cost-effective route. So National Grid ESO in Great Britain has the goal of being able to operate a zero carbon grid by 2025. The article said, quote, "On Thursday, Tesla became the first user to go live with the new API, using its automated real-time trading and control platform AutoBidder to manage first-time BM access for the 7.5 megawatt Holes Bay battery energy storage plant commissioned by Fotowatio Renewable Ventures and Harmony Energy in Dorset." They continued saying, "We're pleased to see our latest developments go live this week with Tesla using our new API to enable a new provider to access the balancing mechanism for the first time." If you're not familiar with AutoBidder, I did a full episode on that topic, which is linked in the description below. I would still consider Tesla's energy division to be in the proof of concept phase. Yes, it has been proven at places like the Hornsdale wind farm, but AutoBidder is still very new. However, these projects are important even on a small scale because they will validate the technology, and once they can develop a track record, the implementation rate will only increase from there. And as we know, in the long term, it is very likely that Tesla's energy business will at some point rival the revenue of the auto business. And the last bit of news before the price target discussion, Zhang Yongwei, Vice President of China EV100, which is a high-profile EV industry think tank, said that Chinese car makers risk falling behind global rivals because the country trails in the production of advanced components like chips and software that are of course crucial for modern EVs. The article said, quote, "China has been the world's biggest vehicle market and producer for a decade, claiming about 1/3 of the global total. But in semiconductors, China has only one company in the top 20. Less than 5% of automotive chips are made in the country, and for some key components, car makers rely 90% on imports," said Zhang. The article continued to say that by 2030, semiconductor-based components would be set to make up 50% of cars' manufacturing costs by 2030, up from about 35% now. So eventually, could we see Tesla licensing some chips and software to these Chinese EV companies? I personally won't be surprised in the slightest if sometime over the next decade that becomes a reality. But getting into the price target discussion, this is from Gary Black on Twitter, handle GaryBlack00. If you don't follow him, do that now. Link is in the description. I wanted to share this because I think his assumptions are very sound. This does not include anything from Tesla Energy, just a quick disclaimer. But I also want to go through a few of the financial metrics so you guys can better understand some of these discounted price targets. He started saying, "I own Tesla because EV penetration is poised to soar from 2.7% now to 20% by 2025, 7 times growth. Assuming Tesla can hold its 22% EV share, Tesla volumes will explode from 500K in 2020 to 3.5 million by 2025. This translates to around $18 earnings per share and a $900 price target in 2025, worth $600 today." And just to confirm, Clean Technica did recently have an article stating that Tesla had 28% of the world's full BEV sales in the first half of 2020. So let's walk through some of these assumptions. SAAR is just seasonally adjusted annual rate. But he is expecting an EV penetration by 2025 of 20%, up from roughly 3% today, which I think is reasonable. If, that is, somebody other than Tesla can step up and make a legitimate electric vehicle. He's assuming that Tesla's EV share of the overall global market will hold steady at around 22%. Right now, in the first half of 2020, as mentioned, it's currently 28%. These EV penetration and market share volumes would take us to a Tesla volume of 3.5 million cars per year in 2025, which is indeed a 5-year CGR or compound growth rate of 48%, and we know Elon has said he expects to grow between 40 and 50%. This price target assumes an average sale price of $45,000 in 2025, and so far in 2020, the average sale price has been just shy of $52,000. I do think this makes some sense as moving forward, the mix will continually shift to Model 3 and Model Y, which should continue to come down in cost, with less of the mix being S and X. Of course, there will be a segment for Cybertruck, Roadster, and the Plaid refresh of the X and X, but I do think a lower trending sales price over the next 5 to 10 years makes the most sense. These figures would result in auto revenue of $157 billion at a gross margin of around 22% holding steady, would yield gross profit of $34.6 billion. Skipping ahead a bit, this is roughly $19.8 billion in net income. With 1.1 billion shares outstanding, that would give us an earnings per share of $18. Using a 50 times PE ratio, that would give us a price of $900 per share, which is roughly a market cap of $1 trillion. Now, of course, this 2025 price target is being discounted to today, or a 6 to 12 month price target of $600 a share by using a discount rate. And it's very simple. Just to illustrate, I pulled up a present value calculator, plugged in the future value of $900 per share. We're discounting back about 4.3 years, and Gary used a discount rate of 9.5%. I'll explain why I believe he chose that number momentarily. Hitting calculate, that gives us a present value of roughly $609 per share. Now, generally speaking, people have used discount rates of around 10% for public software as a service companies, or around 15 to 20% for earlier stage startups, leaning towards a higher value, which, if you think about it, is simple. The more risk there is to the startup being able to execute and hitting certain targets, the higher the discount rate should be. So to put it more simply, a discount rate is basically a representation of our level of confidence that future income streams will equal what we are projecting today. So basically, it's a measure of risk. So the higher the discount rate, the greater the perceived risk, and the lower the discount rate, the smaller the perceived risk. Going back to the PV calculator, if we only change the discount rate from 9.5% and increase it to 12.5%, expecting Tesla to be a bit more risky or to have a harder time hitting these 2025 targets, that would result in a present value of $542, or roughly $67 cheaper in terms of net present value. And real quick, if you guys like this financial stuff and you'd like to learn more about discounted cash flows and valuations, please just let me know below. You can even just leave a money sign just so I understand you're interested in this type of content. But continuing with what Gary said on Twitter, he continued, Tesla Q argues even if EV penetration soars, all the new ICE branded EVs will cause Tesla EV share to plummet. His argument back, ICE EVs have huge brand taint, not cool to drive an Audi or MB-EV, inferior range, Audi's half of Tesla, slower 0 to 60, worse full self-driving, and cost much more. The shift to EV is the biggest consumer tech shift since the iPhone made non-smartphones obsolete overnight. If you own Tesla, you know what I'm talking about. Not having to stop for gas, weekly software upgrades, breathtaking performance make Tesla the best stock of the decade. And I'll reiterate one more time, This price target has nothing from the Tesla Energy division. This is strictly a walkthrough of their automotive business. But let me know what you guys think. Put on your Wall Street analyst hat. If you had to come up with a 1-year price target for Tesla, put it below. That will wrap it up for today's episode of Tesla News. Thank you guys for watching. Please like this video if you did. Consider subscribing for more Tesla content. I hope you have a wonderful weekend, and I look forward to seeing you in the next video.